My name's Austin Forey. I'm one of the managers of the JPMorgan Emerging Markets Trust, and I've worked at JPMorgan for a long time now. I started there in the late 1980s, always working in asset management and managing client portfolios. I began in the UK market, but in 1994 moved to emerging market equities and have been running funds and portfolios there, including the investment trust, ever since. The JPMorgan Emerging Markets Investment Trust was launched in 1991, so we're now just into our fourth decade of operation. And the purpose of the company is really to do what it says on the tin. We provide investors with the opportunity to buy into a portfolio of emerging market companies around the world, and we pursue that objective to try and generate returns for them by investing in the very best businesses we can find everywhere from Chile around to China. So we've been doing that now in the same way for more than 30 years. Investors have a lot of choices, so they can choose many companies. I'd like to think that we can offer them, however, some things that are a bit distinctive. We have a large team at JPMorgan. JPMorgan itself is a big company and has impressive resources around the world. So I'm able, as a portfolio manager, to talk to more than 40 research analysts around the world who specialize in emerging market equities. And they all work in exactly the same process and use a common framework which helps us compare businesses wherever they might be, whether it's in Latin America, Southeast Asia, or Africa, in a simple and comparable framework everywhere. Diversification for us really means very simply not putting all your eggs in one basket, not having one factor which can make or break your investment performance. So we own between 50 and 60 companies around the world in a number of countries and in a number of industries. That's basic diversification for us. But the other thing we do is to make company-specific decisions the core of our investment process. And that's important because we're not trying to find big macroeconomic trends, we're trying to find businesses that can succeed on their own merits in the long run. And that means that the underlying diversification of the portfolio in terms of the kind of companies we own is really what comes out over the long term, and that helps us diversify risk for the shareholders as well. We have over 100 investors who specialize in emerging markets. We don't all do exactly the same thing. Some people are really country experts and run portfolios focused on a single country. Some of us, like myself, are generalists and will invest anywhere around emerging markets for those kind of portfolios. We also have a big team of analysts. I think this is a really distinctive feature of the firm I work for, that we have not only more than 40 analysts who specifically look at businesses around emerging markets, and they do so right around the world and very often on the ground. We've had analysts on the ground in China, for example, right through the pandemic, and been able to continue visiting and assessing businesses in China even through those difficult times. So the research team that we have is important. And what's important also is that they use a single framework wherever they are based around the world. And that means that for me, comparing companies in different industries and in different countries, it gives me direct comparability when I'm assessing the ideas coming out of our analyst team around the world. And that helps me take the best ideas that they generate and get them into the trust for the benefit of the trust shareholders. Emerging markets continue, and have done for a long time now, to grow faster in terms of their economic growth rates than the developed world. And that shouldn't be a surprise. I think there's two particular reasons for that. The first is that a lot of the inputs into their economies are growing faster. Their demographics in particular are often more favourable than you see in mature Western economies, and that's going to be very important over the next 20 to 30 years when we look forwards. But also there's a lot of opportunity for productivity catch-up around emerging markets. And as businesses introduce capital and expertise and technology, you really have a chance to lift incomes and grow out of low income status to middle income status, and sometimes even from that into higher income countries. So with a lot of economic growth going around, there should be opportunities for businesses to grow and enhance their value for shareholders as well over the years ahead. When you look at the investments we've made, it's worth explaining what we're trying to do. What we're trying to do is find businesses that can grow their profits, grow their intrinsic value for a long, long time. In other words, compound their value for years and preferably even decades. And when we've been able to find those kind of investments, they are the ones that make the biggest difference to the trust. These are stocks that don't go up by maybe 10%, they go up eventually by multiples. And that's because the power of compounding really plays out over long periods. And so if you can find businesses that will compound their intrinsic value, that's the biggest driver that you can find and the biggest way you can benefit the shareholders. The way we go about identifying opportunities, really there's two things to think about. The first is we have a lot of people working on it. We have analysts around the world, so we're meeting companies all day, every day, several thousand direct company meetings every year, and that's basic and essential for us in forming a view of the company's intrinsic ability to create value in the future. The second thing we do is have a very clear framework, and everyone uses the same clear framework, and there's a focus in particular on three aspects of any company: its economics, its duration, and its governance. And perhaps the simplest way of explaining what we mean by those is to say economics is about understanding, does the business really create value above and beyond the money or the capital that's deployed in the business? Duration is, if it does, can it go on doing that into the future, and what factors will affect its ability to do so? And that could be the nature of an industry, it could be regulatory policy, it could be competitors. So the duration of the business is about whether a company can create value in the future for shareholders. And then finally, governance is about whether that economic value translates directly for the benefit of shareholders, or whether it is somehow impaired by poor management or poor practices from the owners of the business. That could be, again, bad capital allocation, overpaying for acquisitions, that kind of thing, or it could be straightforward malpractice and favouring one set of shareholders over another. So economics, duration and governance are really the main pillars that we use for assessing the basic prospects of businesses around the world. We get described sometimes as quality growth investors. It's not a label I've ever particularly sought, but it is probably a reasonable description of what we do, and it has two implications, I think, for the trust and the way we go about managing the portfolio. The first is that we're always looking for the same kind of characteristics in the companies we invest in, and we tend to find them, not surprisingly, often in the same kinds of industries and to some extent in the same countries. And so the portfolio has very long-term biases towards certain types of business and away from others. We have a lot of exposure in particular to three main areas: the consumer sector, the financial services industry around the world, and finally technology, which could be everything from manufacturing of semiconductors to provision of IT services. So it gives us a strong industry bias, if you like, in the portfolio, because that's where we find the kind of characteristics that we're after. The second aspect, which is more behavioural, is that we keep stocks for a very long time, and that's deliberate. If you're looking for a business to compound its value over years and even decades, it makes no sense to us to be buying and selling its shares every 5 months, every 6 months. You're not going to capture the benefits of compounding. So behaviourally, quality growth biases mean very long holding periods, very low rates of transactions, and a portfolio that is very stable through time. Many of the risks that people worry about in emerging markets, I think, also exist in the developed world. There is, in every country, a degree of political risk when you do equity investing. There is certainly regulatory risk, and there is always competitive risk to businesses. So it's not as though we're dealing with risks that are somehow structurally different, but I would admit that often they come in different sizes. And you've seen some interesting examples, not always good ones, in the recent past. The most obvious being the political risks which arose as a result of Russia's actions, and that's led to that country becoming essentially uninvestable for us in the future. So risks do exist in emerging markets, and we'd be foolish to deny that. How do we go about mitigating them? I think there's a couple of points to make here. The first is that some of the businesses we invest in, and particularly some of our larger investments, are export businesses. So they're selling more into the countries of the developed world than they are into emerging markets. Their customer base might be corporations in America or in Europe, and that means that their prospects are largely driven by cycles in the global economy, not by what's going on in one particular emerging market. And there's a second point about export businesses which we tend to like, which is they have to be good at what they do. If they're not, no one will use them. Nobody needs to use them. So export businesses is one way of mitigating some of that political and regulatory and domestic risk in emerging markets. And the other is to hold businesses through economic cycles. We're not trying to take a view about one economic cycle when we approach any new investment. We're looking for a business we can hold for a long, long time. And that means that we're not bound to specific short-term economic outcomes in emerging markets in our investment decisions. An investment trust is actually a company. It issues shares to raise money, and that money raised is then what constitutes the funds used to establish the investment portfolio. So unlike a unit trust, it doesn't have clients adding and taking away money every day. It's a fixed pool of money, or closed pool of money, hence the name closed-end fund. And that really gives us the opportunity to make investments where we don't have to worry about the ability to liquidate and meet client demand every single day. And we've exploited that by investing in some quite small companies over the years, and some of those small companies have really helped the shareholder returns as well. So that's the main way in which we've sought to use the benefits of the closed-end fund structure for the trust shareholders.